If you have a startup and you're trying to get business loans this year, you really need to know a few things that have actually changed in the last 5 years. Okay, when it comes to business loans for startups, there are a few things that have changed, especially after COVID. Okay, so it's important to really understand here is that the majority of new businesses need financing to cover just the basics, to cover operating expenses, to cover payroll, to cover inventory. If that's your case, you really want to watch this show from beginning to the end because I'll be sharing with you a few hacks in terms of managing your cash flow, okay, in terms of getting business loans to manage your cash flow, your working capital. And if you're a startup, you also might need money to expand, right? So now getting a loan for a new company can be difficult because what happens here is that lenders are not really just thinking about revenue. They're thinking about what they call operational longevity. In other words, you've been around for a while. So, see, the thing is, if you have an established business, that's in itself is actually a proven track record. So, if the business has been around for 5 years, you know that they have some kind of system to generate revenue on a consistent basis. But if you're new, lenders don't have any sort of metric to judge your track record. Okay, that's why they consider they consider your startup as risky. Okay, because not only do you not have a proven track record, you also are basically are without revenue. Okay, now the best way to use to sort of counter that sort of adverse adverse tendency, adverse, let's say, a perception, is to make sure the owners, the founders of the business have experience in the kind of field that you actually, in the kind of field you're in, right? So if you are in a specific niche, let's say you are in the restaurant niche, you are a startup in the restaurant niche, at least you must have, you as a founder, you must have some experience, okay, in the restaurant industry. If you don't generate revenue, at least you have some kind of assets, and that's intangible assets, okay. But one thing I want to say here is that basically, if you do things properly, you can actually unlock capital for your startup from $10,000 all the way to $100,000. As a matter of fact, there are also some alternative business lenders who are willing to actually fund you for even more. It depends on how you structure your business loan application for your startup. It depends also on the kind of business plan you have, okay, and the financials in your business plan. Of course, when we speak about financials, we are speaking about projections, like pro forma data, right? Not actual data. So, if you are looking for a business loan for startups this year, it's important to understand that lenders will look at a few things across the board. Okay. And whether you go to a traditional lender, a traditional business lender, such as a bank or a credit union, or you go into an online business lender, or you go into a business loan marketplace such as Clarify or a National Business Capital or a Lendio, or you go into, let's say, an alternative business lender such as a SMB Capital or a Rock Financial Capital, it's important to understand that all lenders will look at a few things. They'll look at your personal credit score because, see, your business has no business credit score. Your business has no Paydesk score, no Experian credit score, or Equifax business credit score, right? So they want to look at your personal credit score. So if you have bad credit or fair credit, things to be a lot complicated. But if you personally have good credit, that's a good plus. That's a big plus in your business loan application for your startup, okay? And lenders will also look at your time in business. So when we say startup actually is a generic term to designate all businesses that have been in operation for less than 18 months. So if your business has been in operation for less than a year and a half, it's considered a startup. Of course, you have a brand new startup. But you also have, I would say, startups that have been around for a year, for instance. But this is still considered a startup, okay? So you want to really pay attention to that. Also, your business plan. Your business plan is quite essential. It has to be clear. It has to talk about the business vision, how you make money, how you monetize your business model, okay? How you bring in revenue and how you sustain that revenue, how you acquire customers, how you advertise, the competitive landscape. Why are you better at what you are doing, at least, or at what you are trying to do? You have to really specify all those things for lenders. Okay, what is your competitive advantage? Those are things that lenders want to see, because if you have to create revenue, you got to have an edge. If you have no edge, you can't just sustain revenue creation. Okay, and also you got to talk about your projected revenue. That's what I said a little earlier when I said you don't have actual results, but you have pro forma results. So when you hear pro forma, you it's the same thing as forecast. So your revenue forecast, your projected revenue. And you can do the projections over 3 months, over 1 year, over 5 years. That's really up to, or even over 10 years. Okay. You want to talk about your collateral if you do have some, but also your current income. So if you are employed or have a different business, some lenders will want to know how much you are currently making so that you have a way to pay off the loan if your startup is actually generating some kind of revenue. So when we talk about business loans for a startup this year, let's talk about the application. I spoke to you about the requirements. I spoke about how a startup business loan typically works. Okay. Now let me really dig a little deeper in terms of the application itself. First of all, you need to really understand that there is some paperwork that lenders will require, and some lenders want you to really send the upload the paperwork on a specific website. Some lenders want you to really email the paperwork to them. Okay, like when you go to the website, you fill out a small form, a quick form, a short form, and somebody from the lender will actually contact you. So that will be your business loan representative. So that person will give you their personal email, their professional email, their work email, and you have to send the documents to them via email. Okay. Now everything is secure anyway, though. Everything is protected, so that's pretty good. So the type of stuff that lenders ask, if you are a startup and you're looking for a business loan, they'll ask you for personal and financial statements. So when I say personal and financial statements, you are speaking about financial statements, the business's financial statements. Here we are speaking about the what? Projected revenue, projected cash flow, projected balance sheet. Everything is projected. Depending on how young your startup is, you might not have actual results to show the lender, but do your very best to create pro forma financial statements. Okay. So I'm speaking about balance sheets, cash flow statements, owner's equity statements, but also cash flow statements. Okay, profit and loss as well. So you also want to talk about the business plan and the loan proposal. The loan proposal is important for you to explain to the lender what type of strategy you have, what type of reality you're trying to get from the lender. Okay, what type of numbers you're asking for, and why you want that number. What is the use of the loan proceeds? Okay, also the employer identification number. This is important, your EIN. So if you are a sole proprietorship and you are a startup, don't even think about it. You're not going to go far. Okay, and your business license and operating agreement. This is also important to really think about that. And recent bank statements, proof of business insurance. So you got to have some industries are more, I would say, risky than others, right? If you are in construction, for instance, you got to have insurance. If you are a delivery driver, for instance, if you are in logistics, for instance, you want to have some type of insurance. Something were to happen, at least your business is covered. And also the list of accounts payable and accounts receivable, and also business financial statements. Okay, before I was talking to you about personal financial statements. Now, business financial statements. So when I speak about the documents that you really need for your startup business plan, you have to understand that you need to write a business plan. Now, you don't have to write it yourself. You can have a third party actually write it for you, right? You have a lot of freelancers out there that will actually do the work for you. Okay, it's all about outsourcing what you can outsource and focusing on what you're really good at. Don't try to do everything at once. No, if you try to do everything at once, you won't have time to actually how do I say it? How to actually run your startup. Okay, so a business plan is nothing complicated. You want to have a brief description of your business's value proposition, like what do you bring into the market? What kind of pain points are you solving? and who's your target audience, and why should they care about your products, right? This is actually talks a lot about how you can monetize your product or service, and you also want to talk about your business goals, the market research and strategy. So that's what I told you a little earlier when I said you want to think about how you can position yourself so that you have a competitive edge. It's important to have competitive edge, especially in a pretty tight market, in a pretty saturated market. You have to really exist, especially if you are a startup and you have no competitive advantage. You're not going to really survive. Okay, and also think about the logistics and operations plan, and also the financial plan and revenue projections. I want to insist on that. Projections are really important. Okay, don't worry about actual results. Don't worry about. I would say once you submit the paperwork, don't worry about actually making sure all the numbers are correct. If you use pro forma, if you use forecast, make sure that you are pretty close to the truth based on your educated guess. It's called educated guess, and that just means what? You are using numbers based on your own research or based on your experience. That's it. Nothing really complicated there. Okay, so once you have all the paperwork, you just submit the paperwork and the application for your business for your startup business loan will actually go anywhere from 24 hours to 72 hours. Now, if you apply with a bank or a credit union, your bank or credit union, it will take longer. It might take a week or two. But if you apply with an online lender, a loan marketplace, or an alternative business lender, those lenders are more agile, they're more nimble. So you have a chance to actually have your application reviewed within 24 hours. Okay, 24 hours, you get the decision. It's either a go or no go. So that's at least you have something. You heard something. Okay. Now, one thing I want to say here is that if your loan application gets denied for any reason, you have a few options. You can ask the lender why you were denied in the first place so that you can improve your application. You can also try applying you can apply to a lender with more lenient requirements, such as an online lender or an alternative lender, right? So that's pretty good. And also think about the repayment. So if you are very lucky and your business loan got accepted, got approved, make sure that you have a repayment strategy in place. Okay, review your business budget to see if you can manage the repayments before signing the loan agreement. You can estimate the loan repayments ahead of time by using a business loan calculator. You have a lot on the market. Let me know if you need more explanation on that point. Okay, and so depending on the loan terms, you may be making monthly, weekly, or even daily repayments. There are business lenders out there who wants to reduce risk, like default risk. So they want you to really pay on a daily basis. So if you're paying on a daily basis, there is some kind of impact on your budget, right? It could be disruptive or it could be constructive. It depends on how you look at it and how you organize yourself. If you don't have proper organization, the whole daily pattern can be disruptive, not destructive, but disruptive. In other words, you might find yourself actually, making being short of cash if you have to make some important payments to suppliers or to cover payroll or to buy inventory or to even cover Facebook ads and all that kind of stuff. Okay. Now, during the course of the loan, be sure to make all payments on time. Communicate with your lender if your revenue drops and you think you might miss a loan repayment. The lender may be willing to work with you with your business over time to ensure that the business loan is actually repaid, right? Because it is in their interest to make sure that your startup can repay the loan too. Okay, so that's important to really keep in mind the communication, to really keep all lines of communication open. So one thing I want to say here is that if you're looking for a business loans for a startup this year, you have to understand that it is totally different. This type of loans is totally different from conventional business loans. So when I say a conventional business loans, I'm talking about SBA lenders, banks, credit unions, online lenders. Okay, those are the lenders that you will see with conventional business loans. But when it comes to a startup business loans, you might see banks, but not a lot of banks. You might see SBA lenders, but not a lot of SBA lenders. But you might see more online lenders. You might see more alternative lenders. And you might see also some nonprofits. So you have some nonprofit lenders such as Action or Kiva. Kiva is a pretty good, it's pretty active, but those nonprofit lenders don't give you much. They don't give you that much money. Like for instance, Kiva gives you a maximum business loan amount for of $50,000. Okay, and also one thing I want to say here is that for conventional business loans, the lenders want you to be in business typically at least 2 years. Whereas if you're looking for a startup business loan, you can have like a time range of, like I said a little earlier, from 0 to 18 months. Okay, and also when it comes to a personal credit score requirements, the the criteria are more lenient with startup business loans because basically lenders are looking for a credit score that goes from 500 to a 600 or even 650, whereas the threshold is higher with conventional business loans. Okay, and this is something to really think about. And also, when it comes to startup business loans, you might get actually 1 million or less. I think I've said before, $100,000. But if you structure your business loan properly, if you structure your financials properly, if you actually have a strong pitch, you should be able to clinch a maximum of $1 million. But if you are a conventional, let's say an established business loan, sorry, if you're an established business that's been around for more than 2 years, you can clinch a maximum of $5 million. Okay, so that's really good. And but just be aware that the interest rates are typically lower for conventional business loans and typically higher than the startup business loans. Okay, so it's something to really think about. So, if you think about business loans for a startup this year, you really need to understand that it's not about the application process. It's about the preparation. It's about the paperwork. Okay. It's not about the actual application process. It's about the paperwork and choosing correctly the kind of lenders you want to associate yourself with. Okay. Don't go for banks. Don't go for credit unions. Your chances of loan approval are really, 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 really limited. Even if you have an existing relationship with a bank or credit union, this type of lender is not actually a pretty suitable for a startup because banks actually demand, they require more certainty, something that a startup doesn't have unless the startup is actually fully backed by a VC conglomerate. If you have a startup that's actually backed by a venture capital, then yeah, banks want to do business with them. Okay, and just make sure that you are really focusing on revenue. Make sure that your revenue is pretty solid or at least sustainable. Of course, I'm not asking you to lie when you create your projected revenue, but make sure that revenue is consequential so that at least you can cover the loan where you to be approved, right? Because if you look, imagine you are having projected revenue of $5,000 per month. That's 60 grand a year, and you are asking the lender to give you a half a mil or $1 million. That's really not sustainable, and no lender is going to really approve you for that much, right? So you have to be a little creative and making sure that the money that you are asking for is actually, I would say, suitable for the kind of projected revenue you just are presenting to lenders. As a recap into this conversation, I spoke to you about business loans for startups, and I talk about how a startup business loan works, the requirements, the application process itself, the repayment process. Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.